Hi, Nigel and Renee and everyone at Just Financial. Dave from Bennelong in Sydney, here to provide you an update on the Bennelong Australian Equities Fund and the X20 Fund in terms of performance, recent changes we've made to the portfolios, our current market thoughts, and how the portfolios are currently positioned at the moment. So I'll just get straight into it and look at performance very briefly. Just bear with me here. Put that into PowerPoint mode. So this is performance to the end of September. I'm recording this on Friday, the 29th of October. For the month to date, both of the funds are up. Having said that, now I've probably put the kiss of death on them and they'll probably both get smashed in the afternoon trading session. But for 30 September, look, a pleasingly good performance for not only the market, but for both funds as well. The differences between the funds, the Australian Equities Fund can invest in any stock on the ASX 300. So from anything from, say, the biggest stock like CBA all the way out to stock number 300. But generally it holds 30 stocks and it's aiming to beat the benchmark each year by 2%. So looking at these numbers here for the 1 year, we're up sort of roughly 44% versus the market up sort of about 31%. So beating the market by sort of 13%, but pleasingly for us, it's the 3-year, 5, 10-year number and since inception numbers that we really care about, going back to 2009, whereby we're beating the market but hitting the fund's objective. Likewise for the X20 fund, but excuse me, with the X20 fund though, as the name would suggest, it invests in stocks outside of the top 20. So it is more of a specialist fund. It's looking to invest in middle-sized companies. So it invests in around about 20 stocks and takes bigger positions as well. Its benchmark is slightly different. It's the ASX 300 minus the top 20 leaders, and it's aiming to beat that benchmark by 4% every year. So for the year, it did 45%. Its benchmark did sort of roughly 28. So yeah, beating that by about 17%. But again, the 3, 5, 10-year and since inception numbers, the ones that we're really caring about. So beating the benchmark and hitting the fund's objective as well. Looking at changes we've made to the portfolios the last 6 to 9 months, the biggest change that we made was getting out of resources. So neither funds have any resource exposure at all now. We sold BHP, Fortescue and Oz Minerals the last few months. BHP wasn't in the X20 fund, it was in the Australian Equities Fund. But yeah, we got out of all 3 of those and all resources, mainly on the back of our concerns about the Chinese economy. We're very bearish there. And also just to take the profits on the underlying commodity prices as well, in particular, iron ore, which you probably would know being in WA, spiked to over $200 a tonne. And when that happened, really for us, that was a price signal to take the profits and to reallocate elsewhere. So no resource positions in either funds at the moment. Afterpay is another company that we did really well out of, but we took the profits on back in February of this year. Once it hit $150, that was a signal for us to hit the collect button and to go elsewhere. We like Afterpay, did really well out of it, but they are starting to face some increased competition over in the US, and the US has been a key driver for Afterpay. So just time to take the profits there. Temple & Webster, the online retailer, the online furniture retailer rather, with the really irritating TV ads. We did well out of it, but again decided to take the profits. They're again facing increased competition from the likes of people like IKEA, Harvey Norman, Nick Scali, who are starting to get into the online space. So again, just took profits to reallocate elsewhere. We also think with online that as we come out of lockdown here on the East Coast in particular, that we'll start to see people start going back into physical stores. 3 companies that we bought over the past sort of 6 months. Seek is one that we got into more so around about March of this year, taking the profits from Afterpay to get into Seek. It's in both of the portfolios. Seek, we really like it. It's been doing particularly well for us, was doing exceptionally well before the lockdowns occurred here on the East Coast, as they are experiencing very strong job ad growth. Stalled a little bit during the lockdown period here, but has still performed pretty well. So very strong job ad growth still what we're seeing. Their business in New Zealand and throughout Asia is also ticking along pretty well too. Carsales.com, again, has done really well for us over the past 6 months since we started to get into it. It has basically been the beneficiary of the supply chain issues that we have seen. If you're trying to get a new car or a boat or a motorbike or anything like that into Australia, it's just taking so long to do. As such, you've seen the price of used cars in particular actually increase, and the amount of new ads coming onto the website as well has increased markedly over the last few months. So that is a stock that we think will outperform over the next 12 months. It's also recently made an acquisition over in the US, and its business in Korea is doing particularly well too. Silk Laser Clinics is another one that we've got into over the last 6 months. That is the beauty clinics that you've probably seen in the suburbs, in particular over in Perth, where there's a number of them. They've been doing really well. Again, it's really just been on the back of their store growth. They've got plans for more and more clinics throughout Australia for the coming year and the year after as well. And also just with the average customer that comes into one of these clinics is now spending at least $600 on themselves. So everyone wanting to look good coming out of lockdown, but that's one that is in both portfolios as well. Lynch Group is another stock that we recently got into over the last 4 months. This one, it's a wholesale florist business. It supplies supermarkets as well as retail florists with flowers. The Australian business is going particularly well. It's also got a decent presence over in China. It's one of the few stocks that we own that has Chinese exposure, but that is in both portfolios and is performing really well for us. Then we've got Fisher & Paykel Healthcare and ResMed. Now, both of these stocks have been in the portfolios for a number of years. They were big positions in both funds last year at the start of COVID. They were both really on the front line of COVID. Fisher & Paykel in particular, through the respirators that they make that were being used to treat COVID patients. We de-weighted both stocks towards the back end of last year, but more recently this year, particularly the last 3 months, just with some increased volatility we've seen on the stock market, that both of these are have got some very good defensive characteristics, both ResMed and Fisher & Paykel. So we have increased our weighting in both of those companies. ResMed's a little bit different. Fisher & Paykel's machines are used in hospitals throughout the world. They make all sorts of different things. ResMed also do make respirators, but they're probably best known for their CPAP machines to treat sleep apnea. They have been the beneficiaries of their main competitor in the US, Philips, the company over there that you're probably familiar with. They have had a product recall, so ResMed has benefited from that. Some companies that have done really well for us. Now, two of these companies I mentioned to you when I last saw you in May 2019 are Domino's and IDP. Domino's, I mentioned back then about their Japanese business. Finally, their Japanese operations have started to deliver. They've finally got their menus right. They've got their apps right. They've got their ordering systems right. The management is settled. Japan was massive for Domino's last year, and so too was their businesses in Germany and France as well. So that is a big position in both funds. So that's a hold for us there. IDP Education, that is the student placement company. That was the best performing stock on the market before COVID hit last year. When COVID hit, so too did IDP. Obviously, no students coming into Australia there, so it got smashed. We held it. We think it's a very high quality business. They are actually able to manage their costs particularly well last year, and where they're able to still keep on making money through placing students in overseas universities as the rest of the world came out of lockdown, but also through their English language testing system called IELTS. As we start to come out of lockdown here, particularly over in the East Coast, and as borders start to come down, we think that IDP will really turn around. So we held that. We expect that to turn around pretty sharply. Hardies and ARB have also been really big stocks for us and added to the returns in both of the portfolios. Hardies is massive in the US, also more recently in Europe as well, but that's like one of the biggest positions in both of the funds. So Hardies is something that is a hold for us. ARB, you probably know what they do, the four-wheel drive accessories maker, huge demand for their products throughout the world. Their factory in Thailand just cannot keep up with demand at the moment. They recently struck a deal with Ford to kit out the Broncos over in the US, the Bronco four-wheel drives. But they've been a COVID beneficiary as well, with people holidaying at home, doing up their four-wheel drives, their utes, camper vans, etc. It's run really hard for us, so we have taken some profits on this one recently, but it's still a decent position in both of the funds. Three things that haven't done so well for us, mainly just sort of been tracking sideways, have been CSL, Goodman Group, and the Reject Shop. So CSL's in the Australian Equities Fund, not in the X20 fund, as it's the second biggest stock on the market. CSL's been sort of hit by COVID. It really relies on blood plasma collections in order to make the specialist medicines and drugs that it produces. So COVID has just impacted the amount of collections it's been able to have. Goodman has sort of been tracking sideways a bit. It did really well last year, a beneficiary of COVID, because it specialised in logistics centres and warehouses. So that move to online retail did really well out of. It's just sort of been impacted a little bit by inflationary pressures and bond price spikes. So, but it's something that we will continue to hold. No intention of selling either CSL or Goodman, especially CSL. We love that company. The Reject Shop, that has been hit by COVID as well, mainly through people not getting into as many shopping centres. We expect that to turn around over the next year, though, as we come out of lockdown. Looking ahead, we could talk about this all day, but trying to keep this short and sharp. We expect global growth to continue, but it will be very uneven. The US is really going to be the driver still for global growth, and the US stock market, that is. We are expecting that on aggregate, company earnings will be in the vicinity of over 30% for the coming year. So we are skewing the portfolios towards the US as much as possible. And even the latest data coming out of the US, even the past couple of days, has sort of reaffirmed that. So we're very bullish on the US. Europe and the UK will go all right, sort of 5 to 7% earnings growth there, so not too bad. The big problem is China. There are just so many problems going on the Chinese economy at the moment. So we hardly have any exposure at all to China. I think I mentioned Lynch Group, but apart from that, I can't really think of much else that has any Chinese exposure. So we're very bearish on China. For Australia, we think the overall economy will probably have zero GDP growth. For the Australian stock market, we've come off one of the best years for corporate earnings, really going back to 1983. We haven't seen such numbers, but for the year ahead, it will taper significantly, and we're sort of looking at aggregate earnings of around 10%. But your key takeaway here is within that 10%, there's going to be very wide margins. So some companies will continue to do very well, but you'll have a lot of companies that will be very, very slow, that will either go backwards or will just track along sideways. So we really have got very limited domestic exposure to Australian companies. All of our companies that we've really skewed the portfolios are those that have got their big offshore earnings, particularly in the US. So you really want to be selective and very choosy with what you're owning, basically, is what I'm saying there. Very quickly as to how the funds are currently positioned. So the Australian Equities Fund, the top holdings there, you can see a CSL, Aristocrat, James Hardie, IDP, and Domino's. On the X20 fund, we've got James Hardie, IDP, Domino's, ResMed, Fisher & Paykel Healthcare. The key thing there, again, just to reiterate, we've skewed the portfolios towards those offshore earners. So there's only a handful of domestically focused companies. There's a couple of niche retailers, things like Universal Stores, Baby Bunting, realestate.com, AP Eagers as well. And then just with the reopening that we're having over here on the East Coast at the moment, we've got Corporate Travel is our travel stock. So everything else, though, is very much focused on offshore earners. So I will shut up now and let you get back on with the rest of your day. Just wanted to thank you again for all of your support and hope to get over to Perth at some stage next year to see you all. Thanks again for everything. Cheers. Bye.